Good afternoon. I hope you're good. We are back, but today we are going to explain something different from yesterday. Yesterday we had a CPI. It came out. The data was the same, was maintained the same. So you saw the market going up and down yesterday. Sorry. So today we have what we call PPI at 3:30. I'm recording this at 44:45. So within the next 1 hour, close to 1 hour, we are having a PPI. Let me explain to you. What is PPI if you are new here? Remember one thing, if you want to learn how to, number one, to trade, analyzing things, to be profitable, just always reach out to me. Numbers are always in the bio, then we can always work together. So, PPI means Producer Price Index. Remember, CPI, it looks at consumers, the change in the price of goods and services for consumers. But it starts from things start from PPI. Here on PPI, it means this is now. We are now looking at the cost of production. Let me use a very simple example for everyone. Some of us are in countries whereby they don't release this PPI data. They don't correct this data. Let me explain this. Suppose a gentleman called Moses has a bakery, and the cost of electricity, the cost of cooking oil, the cost of all the things that they use to make bread. Suppose the costs go high. The cooking oil prices, they rise a little. Electricity bill rises a little. The water bill rises a little. What happens? It means by the time this person is producing this bread, it is going to cost more money to produce this bread. So what do? They don't shield themselves with the losses. No. They do number one thing. They transfer this high cost to the consumer. This is whereby you find the price of bread has increased. Now, if you're in Africa, Uganda, if you're in these our countries, because we have less regulations, they may maintain the bread at the same price, but they compromise quality. They compromise the size of bread. They compromise on the ingredients they put in. So you find that the bread that used to taste very nice, it had more eggs, it had more ingredients. You find this bread, they are less. Why? Because they know if they increase the price, people will not buy it. So people will not buy this bread. So it means they are stuck with a perishable product that people are not buying. So because they know this, they compromise. Simple, they compromise on the quality. They reduce it on the size, or they reduce on the ingredients. It still affects the consumer. But in these countries that are highly regulated, they don't compromise on the quality of bread. They have to keep the quality at its best because they are regulated. They are checked. Standards must be met. So what they do, they increase the price of bread, but they keep it at high quality. This is what is called PPI. So PPI today, that data that is going to come out, previous, let's look at previous. Previous meaning this data we are receiving today, it's not from August, it's for July. So previous meaning in June, it was at 0.2%. But analysts, we're talking about journalists, data collectors, bankers, they sit down and now do their research from different states. They look at different companies and all this. So they come out with their estimation. What do they expect? So they are expecting the forecast to be at 0.3%. Now, if the data, the actual data we're waiting for at 3:30 p.m. comes out higher than this figure, higher than 0.3, if it is 0.35, if it is 0.4, 0.5, anything that is higher than 0.3, it means the cost of production is crazy. The cost of production is generally going high within the United States. So what will it mean? It will send an instruction, it will send a signal that, listen, that these high costs in production will later be transferred to the consumers, which is CPI. So if it is later transferred to the consumers, meaning consumers will have to pay, a mother buying bread for the kids, a mother buying milk for the kids, they will have to pay more money to get bread, to get baby's milk. So it means this will create inflation. People are spending more money on goods and services. What does the central bank do? How does the central bank deal with that signal? It deals with it by keeping the rates up or even increasing their interest rates. So if the number comes out, how will it affect the dollar? We are going to have a strong dollar, a very strong dollar. Why? Because if interest rates are kept high or are increased, it means there is more money that comes into the dollar from outside. I normally explain higher interest rates means people who lock their money in the US bond market, they get high interest on their money. So the dollar is going to receive a lot of cash into it. So we're going to see pairs like GBP USD selling, Euro USD selling, USD JPY buying, gold selling. That's if the number comes out higher than forecast. But if the opposite happens, if the number comes out lower than the forecast, what do we expect? It means the cost of production has gone down. The example I gave you of someone who is Mr. Moses, who is making bread, it means the price of cooking oil gone down, the price of water, the water bills has gone down, and all these things. It means the cost of production is cheaper. It means it is going to be transferred again to the consumers, meaning consumers are now going to see a price reduction in goods and services, which is very good for the consumer. So what will it mean? A relaxed inflation. Inflation is being managed. Inflation is low. So what will it send to a signal? It will send one signal. It will send a signal that the interest rates are high, you can bring them down. If the interest rates are brought down by the central bank, which is the Fed, Federal Reserve Bank of the US, if the interest rates are given a signal to come down, what does it mean? It means one thing. We are seeing a weak dollar, very weak dollar. You're going to, if the number comes out lower than the forecast, you're going to see GBP USD buying, Euro USD buying, USD JPY selling, gold buying. Lastly, what if the number, if the number comes out higher, what will happen to someone who's trading stocks or stock indices? We're talking about S&P 500, US 30, NASDAQ. What will happen? It means if the number comes out higher than forecast, it means the cost of production for these companies will affect their profit margins. If it affects their profit margins, it means these companies, you're going to see a sale. You're going to see USD, US 30 selling, S&P 500 selling, NASDAQ selling. Even individual stocks companies that you see like Amazon, they are selling. But if the number comes out lower, it means these companies, the cost of production is low, meaning they are going to get more profits from their production. So what will it mean? It means if the number comes out lower than the forecast, it means one thing. You're going to see S&P 500 buying, US 30 buying, NASDAQ buying. I've given you enough. That is a sweet spot. For us, we trade when the data is just out. We don't trade it when it is not yet out. So this is how you analyze this kind of data. I think I've given you the best. Let's wait for 3:30. You can prove me wrong. But there is also a situation whereby the number is kept the same. It's kept at 0.3. So that one is also there. That's when you see market hitting everyone. People who are buying, they are losing. People who are selling, they are losing. So that's it for today. I would like to continue, go on explaining, but I believe what I've given you is good enough. Thank you. So we are expecting 3 scenarios. Numbers coming out higher, numbers coming out lower, numbers being maintained the same. Thank you. We'll meet again.